For Morningstar, I'm Jeremy Glazer. Our Director of Personal Finance, Christine Benz, has been keeping a close eye on mutual fund capital gains distributions so far, and we're going to talk about some big themes that she's seen emerge. Christine, thanks for joining me.
Jeremy, it's great to be here.
Let's start by just talking about the mechanics of why funds have to do these distributions. What's behind this?
Well, if a fund sells a security that has appreciated since purchase, it has to pay out any capital gains that it realizes to its shareholders. And if the shareholders own the fund within a taxable account, they will own capital gains taxes on that distribution. So that's why at the end of the year, we tell investors to keep an eye out to see what their funds may be paying out in distributions.
So what are some of the big themes you've seen emerge of the kinds of funds that are having distributions this year, or big distributions this year?
Well, a couple of overarching themes that have contributed to distributions over the past few years have been the fact that we are in the midst of this tremendous bull market that has been running into 7+ years now. And so what happens is that managers have certainly burned through any capital losses they had on their books left over from the bear market. Now, if they're selling securities, for the most part, they are appreciated securities. So that's been the big catalyst, just the fact that we've had this long-running equity bull market. Securities are hitting managers' sell targets, and they are getting sold out of the portfolio. The other big overarching theme is that on the fund flow side, we've had this exodus from actively managed products, actively managed equity funds in particular, and into passively managed products. And so that has created an impetus for managers to sell securities. They've needed to raise cash to meet investor redemptions. So that has led to capital gains being realized. And in turn, what happens when those distributions are made is that if the shareholder base of the fund has shrunk over that time period, the distributions get spread across a smaller shareholder base. So the net effect is that as a percentage of net asset value, it's bigger. The capital gains distribution is bigger. So the two overarching themes, bull market plus this trend toward passively managed products away from some of the active funds.
You see manager changes as being another big impetus or big theme here.
Yeah, sometimes when we see the very large distributions, that's what's going on underneath the hood. So naturally, a new manager who comes aboard a fund, even if his or her strategy is somewhat similar to the previous managers, the new manager, chances are, wants to make some changes to reshape the portfolio to his or her liking. So that may cause sales that in turn trigger capital gains distributions. So that's one issue. Another related issue is that sometimes funds that have manager changes have redemptions. So investors may not like the manager change. They may not like this feeling of instability, so they may be selling their shares. In some cases, perhaps poor performance precipitated the manager change. So perhaps the shareholders were feeling a little bit restless even before the manager change, and they may be selling as a result. So that confluence of factors can tend to contribute to big capital gains payouts at funds that have seen manager changes. A good recent example is T. Rowe Price Growth and Income. It's a fund that we actually like. It's bronze rated, but it does have a new manager as of 2015, Jeff Rottinghouse. He made some changes to the portfolio, and that fund is anticipating a distribution in the neighborhood of 17% of its net asset value. It's a fund that we like, but shareholders who want to hold it in a taxable account will be seeing some capital gains distributions this year.
You're also seeing some big distributions from funds that have kind of a boom and bust performance cycle.
And I would say this is another reason to perhaps avoid some of these funds that do have explosive upside performance followed by these very weak periods. They tend to bring out the worst in investor behavior, where you see investors gravitating to them after they've sort of scaled their highs, and then we see inevitably when they hit these weak patches, investors start to leave. And so some of these fear-greed cycle funds are prominent on the list among funds that are making big distributions this year. One I would call out is Morgan Stanley Institutional Small Cap Growth. It's actually a fund that we like a lot. We think its manager is very talented, but it is a fund that has had very weak performance recently. It has seen redemptions, and it's expecting to distribute roughly 25% of its its NAV between now and year end. So that's a fund, good fund, but poor choice for a taxable account because of this boom and bust cycle that it tends to experience.
Closed funds could also potentially have big distributions.
They can, and typically on our list of funds making distributions, we do see several closed funds. And the reason is that it's easier for money to leave a fund than it is for new dollars to come in. That typically investors can't buy new shares, but current shareholders can sell. And so that can force some selling at the fund level where the manager is having to sell securities to meet redemptions. One fund on this year's list, a fund we like a lot, is Vanguard Capital Opportunity. It's not making a huge distribution, but it has long been closed to new investors. I think what's going on with that particular fund is, even though it's a growth-oriented fund, its managers are pretty valuation conscious, so it's a good bet that some securities in the portfolio have been hitting their sell targets recently. That has forced a sale in some long held and highly appreciated positions. So we can tend to see distributions coming from closed funds perhaps more often than funds that are open.
We've been talking about actively managed funds here, but index investors shouldn't totally ignore this capital gains season.
Right. We usually say index funds are a pretty good mousetrap when it comes to your taxable accounts, in part because the broad market index funds have very low turnover. They tend to pay out very little in the way of capital gains distributions. One exception, and one that we wrote about last year too, is JP Morgan Equity Index. It's an S&P 500 tracker, so very low turnover index. The problem is, we think, is that the fund has seen asset outflows as investors have been flocking to cheaper alternatives. There are certainly cheaper S&P 500 funds on the market. And so what has happened is that the fund has had big redemptions. It's had to sell appreciated securities. And so it is forecasting a distribution of roughly 9% of its NAV this year. It also made a big distribution last year. So even though index funds are generally quite tax efficient, it's not always the case, especially if it's not an ETF. ETFs have some mechanisms to really limit their capital gains distributions. Traditional index funds like the JP Morgan fund don't have those mechanisms on hand.
Christine, thanks for joining me today.
Thank you, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.